welcome back to the Retention Edge podcast. I've got Abir, co-founder and CFO of UpCounting. Abir, why don't you give everyone a quick intro on yourself, man?
Sure. Thanks for having me. So my name is Abir. I'm the co-founder of Accounting, which is an accounting and CFO services firm that focuses on e-commerce brands. In terms of my background, I used to be a CPA. I don't really do much CPA stuff anymore, but I've had the experience of kind of like the traditional accounting and finance route. But I've also been fortunate enough to run an e-commerce brand as well as a performance marketing agency. So I have a bit of a unique set of perspectives in terms of being able to combine the marketing side and the finance side when it comes to e-commerce. So yeah, that's me.
And what issues do you see kind of in the overall financial ecosystem with different accounting firms and everything else that you decide like you wanted to start your own thing and where were all these businesses going wrong?
It's funny because I generally did not want to start an accounting firm. I'd worked in them in the past. I wasn't the biggest fan. So that's kind of part of the reason that eventually when I had to leave the last job that I had, one of the things that I tried to do was build a marketing agency, which did go very well. But as time went on, I realized that there was just this very substantial need that e-commerce brands had with respect to having better access to accounting and finance data. And it didn't really come as much of a surprise to me, given the fact that I kind of know what most accountants are like, that a lot of them were just unable to kind of provide the level of granularity or a thorough enough understanding of really what makes e-commerce tick. And I think e-commerce is not an insanely complex business model, but it is relatively unique. So, insofar as service providers who have just never worked with e-commerce before, and there are a lot of them who really just have none of that e-commerce experience, but still work with e-commerce clients. A lot of times there were gaps in terms of the types of reporting that they would do, how they would handle the data, how they would do kind of channel level segregation of the data to be able to kind of report on Shopify separate from wholesale, separate from Amazon. And the lack of understanding of that business model was something that I think created a lot of gaps insofar as like how founders were able to understand the data. So to my mind, just kind of having worked with a lot of e-commerce brands, having run an e-commerce brand, it just kind of became a little bit more obvious to me, and that there was a need there. And given the fact that I had the background to be able to deliver on it at a high quality, I was like, it just kind of makes sense to do that. So started up the accounting firm, had the agency for a while in parallel for a bit, but it became a little bit too hard to do both things at the level that I wanted to. So decided to just kind of go all in on the CFO side.
So you work with dozens, if not hundreds, of different e-commerce brands. So you have this pretty large oversight on the market right now. I want to start off before we get into detail on like uh, the individual businesses themselves. I think you should have a relatively good understanding of like the market right now, right? Like all these different industries, all these different clients. Like where do you see e-commerce right now? uh, have all the concerns of tariffs kind of like move past now? I don't hear about it as much as I was hearing about it back in April, May, June. Like where do you think the e-commerce industry is at this point?
I'd say it depends on who you're talking to. It'll get a different sense of kind of like what the issues are, or how it becomes a lot more. It's certainly become more difficult, especially compared to the days of old, like 6 years ago, when meta ads were a lot easier, attribution was a lot easier. You didn't have tariffs and stuff like that. But fundamentally, I think it still is, despite the fact that it is a little bit more mature as an industry, which just means that there are more people kind of getting into it, and so competition kind of rises as a function of that. In some regards, that does make it more difficult, but the maturity also means that there is more growth, there's more opportunity, there's more resources available to be able to kind of play the game a little bit more with a little bit more sophistication. So broadly speaking, I'd say that the main kind of trends you would see over the last few years is that customer acquisition has become a lot more difficult and a lot more expensive. So there is an aspect of being able to kind of just be a bit more sophisticated about how that's being approached. And the kind of follow-on effect from that is that because of the fact that it's not as easy to just kind of like chuck up an ad account, let it rip, just pump an ad spend, and kind of just have an incredible ROAS. There is a need to be able to bring a little bit more of that sophistication with respect to how the business is run and treating it a little bit more like an actual business. So thinking about your financial models, your cash flow, and stuff like that. And I think that there's that maturity is starting to kind of show in the industry. A lot people are becoming a little bit more conscientious of that. With respect to the tariffs specifically, it is certainly something that is an unfortunate challenge that a lot of people had to navigate, but there was also something, to a certain extent at least, like we're all in the same boat. So it affected some brands a little bit more than others, but everybody kind of did what they had to do. The things kind of normalized to a certain extent. And again, that's still a bit of a dynamic situation that might improve over time, depending on how certain legislation and whatnot plays out. But all that to say, most people made the adjustments that they had to. They kind of got around it, and things are still chugging along.
It it's funny. I follow a lot of different e-commerce influencers, and they're talking, and they tweet. I just talked to 10 brands all doing more than $20 million a year, and all of them are gonna be less profitable this year than last, or whatever. All these different takes. I guess based on your data set and your view of all the different brands you work with, like, is is this year more challenging than last? Are brands less profitable than they were before? Are they struggling on the revenue side? Is it a profitability issue? Like, where do you see the trend going for those businesses?
That's a good question. I mean, overall, I would say that I do kind of see something similar. Profitability is a little bit more challenging. Part of that, I think the two main things contributing to that is part of it is, at least for some brands, the issues with the tariffs and kind of what sort of a knock on effect that had from a COGS and gross margin perspective. But the other big part of it really is just kind of the acquisition side. A lot of brands are struggling to change their strategies from an acquisition perspective. And so they don't like the idea of revenue going down. They don't like the idea of decreasing spend. So they just eat, the cost of that higher CAC. And that naturally just kind of leads to lower profits on that side. There are still some brands that are crushing it and doing well. And those tend to be the ones who are able to kind of navigate some of those challenges, because at the end of the day, there are going to be winners and losers. But certainly, I'd say overall, there is probably a little bit of that downward trend. It doesn't really help that I think economic activity has also kind of been affected a little bit by just certain things going on in the States. So there has been a little bit of a reduction in terms of kind of purchasing behavior to some degree. So there are those economic headwinds, but yeah, some people are able to navigate it better than others, but generally there has been kind of a bit of a hit to profitability across the board.
Are you noticing stark differences between different markets, or is it similar across the EU, Canada, US?
Most of my data would be coming from Canada and the US. We do have a handful of European clients, but I wouldn't say enough to be able to kind of, for me to be confident that I'm seeing a trend that I'd comment on.
Mhm.
But for the most part, it probably affects the States a little bit more than Canada, but those two countries tend to kind of go be in
Yeah.
lockstep to a certain extent with respect to kind of economic situations. So it's not terribly dissimilar between the two.
Uh, you were mentioning a little bit earlier about customer acquisition, how difficult it is for go back 6 years ago, Facebook uh, ad spend, you could just scale, 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 and grow the business that way because it was just so cheap to acquire customers. Now it's super expensive, and we're recording this 2 days before Black Friday. Yeah, 2 days before
Yeah.
Black Friday. Obviously, Black Friday costs increased 3 to 5x to acquire that same customer as it would have 2 months before. Um, what are you seeing from brands in terms of retention? Uh, are they increasing their spend on retention tools, retention strategies? What are you seeing in that space to account for the fact that if a customer costs $50 to acquire, you need to make you need to earn $150 to make it worth it instead of $80 to make it worth it.
Yeah, not enough, I'd say. There certainly are a lot of brands that do still struggle to kind of shift their paradigm from just kind of an acquisition only strategy to like actually taking retention a little bit more seriously. There is certainly an improvement on that front. People are kind of recognizing the fact that there are depending on the brand, sometimes low hanging fruit with respect to retention. Sometimes it's just kind of value that can compound over time because it obviously just improves the LTV for all the customers that you're acquiring. But certainly, while I have seen increases in investments on that front, and while I have seen a lot of cool technology kind of coming out that can make that whole, the retention side of things a little bit more sophisticated, there's still tons more that brands could be or should be doing.
So, from your perspective, it's been completely underinvested in compared to customer acquisition.
It has been forever, and it still is. I think, and to a certain extent, I kind of get why. In fairness, there is an aspect of how retention is very much a downstream kind of impact, or is impacted by the efforts that you put on the acquisition side. So I mean, without a
Mhm.
very very strong acquisition machine, retention can only go so far. So ultimately, being able to focus a lot of the attention on the acquisition side, I understand, and especially because a lot of brands have succeeded and gotten to where they are through very strong acquisition machines. As that machine's kind of eroded or its ability to generate value has eroded, it's hard for them to completely shift their paradigm, so they just keep trying to solve it, and ultimately it's understandable because if they can solve it, there's a lot of value there. The thing is that it's just a question of, I guess, a proper split of attention. I think a lot of them just don't realize that there is so much value to be had from the retention side, and if they're able to kind of make that work a little bit more, it just gives them a bit more of a cushion on which to sustain the business, so that they can keep working on that acquisition machine and trying to crack it or re-crack it if it's broken. But yeah, a lot of people just have that difficulty because, again, I understandably so, acquisition is just a lot more fun.
Do you see a stark difference in in the financials between a brand that is heavily invested in focus and retention versus the brand that's all in on acquisition and sends a couple emails here and there?
Oh, undoubtedly. The difference is very, very substantial, in part because of the volatility that you'll get if you're focusing specifically on the acquisition side. There are brands that like have completely collapsed. I mean, they were doing seven figures a month, doing extremely well because they were very heavy on the acquisition side, not putting enough attention to the retention side. And then when the acquisition machine broke for them, like their business essentially collapsed, and the the kinds of changes they had to undergo to kind of compensate for how dramatically things changed were very painful. As opposed to some companies where retention is a very core part of what they do, and oftentimes they might be under investing in acquisition too, because you have brands on the other end of the spectrum too. For them, there's just a lot more sustainability. So not only is it that you will have a little bit of a harder time running your business when you have volatility from month to month, but it also makes it very difficult to plan. It's hard to,
Hmm.
if you're an acquisition business that gets all of your revenue and your contribution margin from essentially being driven by Facebook ads, and you want to say invest in new product launches or building out retail in the new year or something like that, some of those channels require a lot of investment, a lot of capital to be kind of outlaid before you're able to kind of see an ROI. And you're hoping that the acquisition machine keeps running the way it is and meta ads keeps performing the way it is to be able to subsidize some of those activities. But it's very volatile and it's hard to know that it will. It becomes a lot easier to forecast out your revenue and your performance and build a business around that when you have something a little bit more reliable, and retention revenue tends to be amongst the most reliable options you have.
Do you find that retention revenue can help like you said, stabilize the business in terms of growth? Do you find that uh, that retention revenue changes though, depending on if it's subscription versus just optimizing for returning customers? Like, very rarely is there a subscription business in fashion, right? But fashion
Yeah.
obviously still has a lot of repeat purchases and therefore focuses a lot on retention. Like, how drastic is the difference between those two business models?
It's funny. So it's a good question because I was actually looking at a brand that we work with yesterday and kind of comparing their subscription revenue, their non-subscription revenue. I wouldn't say it's incredibly dramatic, because of the fact that like ultimately the same mechanisms do apply to a certain extent. It's just the beauty of subscriptions that's just way more reliable. So it kind of dies down a lot more
Mhm.
slowly. It's a lot more stable. It's a lot more reliable. With, call it, one-time retention revenue, you'll just get a little bit more volatility, but it's still far better than your acquisition side in terms of reliability.
What would you if and it's going to change business to business, but if you had to like guess on what the cost breakdown is in a business between how much they're spending on acquisition versus what they're spending on retention. Is it 90/10? Is it 99/1? Like what would you guess is kind of that breakdown?
Um, I would probably say 95/5. The vast majority of the resources go to acquisition. I think when it comes to, especially when it comes to paid ads, creative, and agencies on that side, it's a little bit more obvious. You can make an argument that's the stuff that's invested in like organic social and stuff can kind of go either way, but let's just
Mhm.
kind of ignore that. The amount that's invested in retention will almost entirely come down to a few softwares and then maybe like an email freelancer or agency. Sometimes they just
Yeah.
kind of give it as like a side note to like the marketing manager also sends the emails internally if they have a full-time hire. But certainly it's yeah, probably closer to 95.5 for a
And
lot of brands.
so if that's kind of like the average, what do you see that breakdown being for the healthiest or the best brands? Uh, yeah, what would you guess is that breakdown?
It's tricky to answer that because it really depends on the business model. So for a brand that, let's say something in the consumable space, you're doing beauty or supplements, you're not necessarily subscription heavy, but there is an opportunity to kind of reactivate customers quite a lot. For someone like that, it might make sense to go something like 80/20 or something,
Hmm,
maybe 85/15 or something. Because to a certain extent, the it's inevitable regardless that you're going to have a much higher amount invested into the acquisition side because there's an aspect where you constantly have to move the goalpost to be able to kind of improve the quality of your acquisition to be able to acquire larger or to target larger pools of customers with kind of effective creative and whatnot.
hmm,
On the flip side of the argument, you could say that it takes the same amount of effort to build a really good email campaign whether your email list is 100 people or 100,000 people. The effort's the
that's a
same.
good
So it
point.
really just comes down to like what the ROI is, which is a function of kind of like how many people you have on that list and how much revenue you can kind of generate from it. So it does depend a little bit on the brand because like if you take one that isn't necessarily a high repeat purchase brand, like it's a durable good, you might be closer to 98 2, and that might make sense.
Yeah.
Just because most people don't repurchase, so that's understandable. So it would depend on the brand, but I don't think there'd be a point at if I saw a brand that was spending um 50/50, for example, and 50% of their effort went to retention and there was like an actual ROI on that, that just tells me that their LTV is so damn good that they really should be spending a lot more on acquisition.
Hmm. The so that's actually kind of interesting because uh obviously we're in the mobile app space, and so we
Mhm.
have this pretty good insight into all the different brands and what makes them interested, what makes them not interested in an app, what and then at what size does it actually start to make sense, right? And to your point, it does depend on the brand and the category they're in, beauty versus chairs and whatever, right? Not a lot of retention in chairs, lots of
Right.
retention in the face creams that people use and lipstick and whatever. Uh, Ignoring the category though, it's become very clear to us that if a brand's doing under $1 million a year, they will not think about retention. They'll set up some basic email
Yeah.
campaigns and whatever else, but retention's like the last thing they're thinking about. It's new customer, new customer, new customer acquisition.
Mhm.
Once they get closer to $5 million a year, that's when they start thinking about retention and actually focusing on it. I'm curious if you've seen some similar trend or if you have specific numbers in your head that you'd kind of guess as to where, it really does start to make sense to focus more on retention versus just focusing on customer acquisition.
Yeah, I'd say that's not a terrible range. It does kind of work because I'd say if you're an e-commerce brand founder who is really just trying to build a really chill lifestyle business, and there aren't that many. I mean, some I'm sure exist. At least not the ones we work with. So you're comfortable just being like, oh, I got somewhere like between 800K to 1.4 million of revenue. I'm running at a 30% profit margin, and like that's cool for you to be able to like live life and stuff like that. Then I can understand for
Mm,
them a lot of times, especially if it makes sense from the perspective of like where their customer revenue comes from or what their business model is. You can just say like, oh, I have a small amount of ads, we do some organic content, we have some influencers, they kind of send us a certain amount of acquisition, and the rest is like mostly retention revenue. I have seen brands that have their retention revenue in like the 60 to 70% range. I think
mm,
they're underspending on acquisition, but I've seen it. And so you can take that approach. But the vast majority of the brands that at least we get to work with are ones that are very ambitious. They want to be able to build something that's very substantial. They want to be able to exit someday. They're in it for the love of the game. So like they are aiming for like very, very substantial outcomes. And those very substantial outcomes necessarily require cracking the acquisition machine. So it's if you are, for example, very heavy into like a consumable or a subscription brand, I'd say then it can make sense to invest heavily into retention early on because it can give you a realistic understanding of what your LTV can be, which determines what your CAC should be. But if
Mhm.
you're something that's not like super, let's say you're more like an apparel or something like that, where it's not like, yeah, there is obviously some amount of retention, but you're not necessarily playing the LTV to CAC game, especially if you're bootstrapped and you're trying to be first order profitable. It makes sense to say, let me just put all my effort or the majority of my effort into trying to be first order profitable, and then also move the bar, if you will, insofar as like how much can I spend while still being first order profitable. That's the game that you should be spending a lot more time playing on. You can do the retention thing on the side, and you just get, it's just gravy at that point, just bringing in additional value. But it can make sense to invest a lot more heavily earlier if LTV to CAC is the game you're playing, because you're in like, I don't know, subscription or consumable. But all that being said, I think you're kind of pretty bang on with the numbers that like prior to 1 million, send some stuff just to kind of like do it because it's kind of free money. You might as well. But really,
Mhm.
it's I'd say 5+ where you, or 10+ where you should be like focusing a lot more on having a robust retention strategy.
You said something kind of interesting there around the split between returning customer revenue versus customer acquisition new revenue. And you
Mhm.
said if they were 60% returning revenue, you'd recommend invest way more into customer acquisition. What would you say is kind of that healthy split? And again, I understand it's going to change from category to category, but for a business that is going to be reliant on repeat purchases, it's going to the beauty, supplements, fashion, those different types of categories.
Obviously, this answer is very nuanced, but 20 to 40%.
20 to
20 to
40%.
40% is probably something where you should be seeing like a decent amount of like that's probably reasonable, depending of course on the industry from a retention perspective. If you're at like 10%, it may be that your category is just a durable. It doesn't make sense anybody would repurchase because of the nature of the product. Nobody needs two
Mhm.
of them. So
No.
that can make sense. It's obviously, it affects the strategy because you have to be, again, very focused on profitability at the beginning. um, but almost certainly if you're above 60%, it's just more likely than not, unless it's just one of those categories where like there might be unique ones where it's something like, I don't know, printers, for example, where you're gonna get a person to purchase a printer, and then you're just gonna sell them ink forever. Then okay, cool, but maybe it's just very very difficult to acquire that printer customer. So it's maybe if the CAC is way too high, you could say like, okay, yeah, over time you just stack so many existing customers, the cost to acquire new customers has just gone up too much. So sure, it like
Mhm.
60% makes sense, but generally speaking, if you're at the 60% range, chances are you need to put more effort into acquiring new customers because you can just kind of compound and make a lot more money.
When you're talking to different founders, I guess what are the biggest mistakes that they're commonly making before they come to you, that you're kind of discovering or unfolding alongside them? And I assume the biggest one, and you hear it all the time, is going to be cash flow, right? They don't realize, you're buying products months in advance, then they're
Mhm.
selling it. There's this large overlap in time between when your costs go out and when your profits and your revenue starts coming in. But what are some of the most common mistakes you see founders making?
Yeah, so there, I'd say maybe three. So the first one, you got it. It's cash flow. A lot of people don't know how to manage their cash. They focus a little bit too much on like, I don't know, their triple whale dashboards. They're just looking at Shopify revenue and ad spend, and then that's kind of like all they pay attention to. So the cash flow can kind of hurt them when inventory cycles come into play. The second one is that they don't look at their financial data. So they just don't really, it's either not done very well. Most of the time, it's not done very well. But even if it is, they don't really like look at it or pay attention to it. So they don't have the level of granularity to be able to kind of understand, especially if they're omni-channel, how different channels are performing, how different aspects of the business are doing, and where that means they should be optimizing. And the third part is that they just don't know what KPIs they should be targeting. Like they don't know what healthy is. They don't know what their break-even ROAS is. They don't know what their CAC should be. They don't know how much they should be spending on agencies versus creative versus personnel. So just not really having a sense of like what they should be trying to do, and then also not having the data to compare it to anyway.
Mhm.
Those all kind of just compound, because the most common thing is that like I get that accounting data is not exactly fun and exciting, but at the same time, the truth is that like every founder who gets the clearer data, they immediately like, okay, now I know what to do, because ultimately that's what it is. Business is just about making good decisions, right? I mean, like, that's
Yeah.
essentially what the whole game is. So if you can make good decisions, you can win. And a lot of people just don't know how to make good decisions, so they end up kind of feeling a little bit stuck and paralyzed, and then they just kind of default to the thing that's the most familiar to them, which is like, let me just try to figure out how to spend more on ads. But especially if you're not a marketer founder, then you'll just end up kind of spending a lot of time just holding things together rather than kind of figuring out how you can break out to the next level because you just don't have the data to know what the next steps should be.
What is that typical breakdown of uh, that typical structure that a brand can operate under, where they can spend X amount on marketing, X amount on personnel, X amount on inventory, everything else? And again, going to change depending on the vertical that it's in, but kind of what are those ranges that they should be operating within?
Oh, so you mean like kind of like percentages to each of those categories?
Yeah, yeah.
So very high level, I'd say maybe about 25-ish% should be going to your cost of delivery. So the product, the fulfillment, the merchant fees, all that kind of stuff. Um, Maybe about 10 to 15% going to personnel, about 5% going to software, about 5 to 10% going to agencies, about 20 to 30% going to advertising, and then maybe like 5 to 10% to like other random admin costs, and then hopefully you have a bunch left over for maybe like 5-10% left over for profit. I think you can optimize a bit more for net profit if your goal is to just kind of pocket a bunch of cash or whatever, or if you're smaller and you need some to kind of live. um but I think
Important.
for yeah, but I think once brands get to a certain size, and if they're like at least the founder is comfortable enough that they are able to kind of sustain the lifestyle that they want, a lot of times it just makes sense to try to reinvest as much of the profits as possible because the faster you're able to grow, the bigger a piece of the market you're able to acquire. Usually, that does end up being more favorable from the perspective of an exit. So you don't want to leave too much over for profit.
When founders are dealing with cash flow issues, there's a lot of places that they can go to solve those issues, right? Shopify offers their own product where they'll lend you X amount of money. There's I think they changed their name. It was like Clearbank or something. Now it's
Mm.
Clearco or
Hmm.
whatever.
Yeah.
There's a bunch of different options out there. What are your takes on those potential options? I hear a lot of controversy around Shopify offering that solution. I think recently Shopify reported they lost a crap ton of money on it in their most recent
Mm.
quarter. But I guess from the brand side of things, like what's your take on those types of options?
I would say that it is important to make an educated decision. And I think it's difficult for a lot of people to make an educated decision. I mean, that's kind of part of the reason it's helpful to have people like us. Um, if I had to simplify it, it really comes down to understanding your cost of capital and comparing it to the other options that you have, and then having a very clear understanding of what the use of those funds are and how quickly and how big the ROI is going to be. So, what I have seen brands do is that they're just kind of chugging along. Their unit economics are not great. They are acquiring customers at a loss, and their retention is not healthy enough to keep them profitable. So they're having many months of negative profit or losses essentially, and they're just like, oh, I need cash. And then they just go to the source of cash that is the most easily available. So a Wayflyer, a Clearco, a Shopify Capital, whatever. But they don't have a specific use for that cash. They just, I need cash, so let me go get cash, and then I'll figure out how to pay it back. And I don't think that's the right approach because very often, if you don't have a specific use for it, the problem that got you into a negative cash flow situation to begin with, it'll probably continue and just burn through the debt that you acquired, and then you're just going to shut down your business later. So you're buying yourself some time, but you don't have a plan. And I'd say that's probably the biggest mistake. So can things like the what some people consider to be a little bit more predatory, like say a Shopify Capital or um, Wayflyer or whatever. Sorry about that.
It's all
So
good.
can people consider that? So I don't know this. Why this may? I apologize. This thing is my iPad doesn't silence itself. So can that be a little bit more predatory for the people who consider Shopify Capital or Wayflyer to be poor sources to get funds from? Yeah, it can be. But I think that if you know what you're doing, if you understand the value of being able to get funds very quickly, there is an importance to being able to do there's a value to those sorts of options existing because of the fact that they can provide capital to people who otherwise would not be able to get funding from traditional sources. If you go down the very traditional routes, it can be very difficult, especially if you're a new brand, you're in e-commerce, and that lender doesn't really understand how e-commerce works. You don't have a lot of borrowing history. It might be very difficult to get funding. But if you again have a very clear understanding of what the cost of capital is, you have a very particular use of proceeds, like I'm going to take that money, I'm going to buy this inventory, I'm going to sell through it for Black Friday, I know I'm going to make this much of a return, I'm going to be able to pay it back in that much time. It can totally make sense. Sure, it'd be nicer if it was a little bit cheaper, but it can make sense. The problem is that most people just aren't making educated decisions.
I imagine that most difficult part of your job to an extent isn't in the actual work itself, but it's about fighting the psychological habits of the founders or the teams that you're working with. Because to your point, like, if I'm going to go to Shopify or go to wherever and get a loan for money that or for cash that I might not need, I might not literally need the cash, but I don't feel comfortable if I don't have it, right?
Yeah.
And there's everyone's got their own psychological biases with money and how they spend and all these different things. So I imagine that that's probably, if anything, the hardest part of your job. It's not like presenting, "This is what you should do." That, if anything, might be the easiest part of the job because it's numbers at the end of the day. But
Mhm.
actually convincing someone that this is the way you should do things and fighting against their own biases is the struggle. But correct me if I'm wrong on that.
No, you're absolutely right. It's I had a similar experience like last week or so. Because again, a lot of what we do is just math to a certain extent. It might be a little bit
Yeah.
complex math, but it's just math. It's not the hardest thing to be able to prove that the math is mathing. Where the challenge ultimately comes up is usually around the assumptions. So there are always going to be these unknowns about like, oh, how much are we going to spend next quarter, and what's our CAC going to look like, and those kinds
Mhm.
of things. What is LTV? And so some of those things are going to be based on estimates. Some of them are going to be based on just kind of guessing essentially the future. And I think that's where the biggest challenges come about because a lot of times people or founders just don't like the answer they're hearing. So for example, there was this one brand that I was talking to where I was trying to tell them that, this is your LTV based on historical data. I hear all the things that you're doing on LTV. I see that it is kind of, improving in the recent cohorts. So let's pad your LTV a little bit, even based on, regardless of the historical data, let's pad it a little bit more. Ultimately, though, you're still going to be able to have to hit this CAC and you're way above it. Like, it's just not going to work.
Mhm.
And like, there's just one thing, it just, like, they didn't want to believe it because the problem is that the CAC had just been rising over time. And if I was right, then that means they had to spend less. And that means their revenue would go down. And that's not fun. And I totally get that. But that's the challenge. Like the reality is it's most people, marketers, founders, whatever, most people consider themselves to be data driven. What they really mean is that they'll agree with the data if it's so cold, like so hard that like there's just no room for disagreement. Like you can't argue 2 + 2 is 4. But the problem is that as soon as there's any room for interpretation, the biases kind of come in and they'll just kind of convince themselves that they're data driven because it comes down to like, yeah, that's what the data says, but this is how I'm interpreting it. And that's kind of like the challenging part because they're a little bit more emotionally tied up in the outcomes, understandably so. And in fairness, you could say that we're probably a little bit more conservative, but that generally has served well for most cases, rather than underestimating what you're capable of doing.
So that's a good point. So there's a psychological part, and then there's the assumptions part. How what I guess the assumptions part is kind of is the hard part as well because you're assuming X growth, or you're assuming that this product won't suddenly go out of style and nobody wants it anymore. You're assuming that LTV is going to stay the same or even grow. Like in the SaaS market right now, there's a lot of revaluing of different solutions because we always assumed that
Mhm.
if you acquired a customer for $100 next year, they would be paying $120, and then that same customer would then be paying 120% more off that, or whatever. And a lot of these models are breaking now because of AI, because of all this new competition, blah blah blah. um how do you guys make what's your process for making these assumptions, and how do you feel confident in making these assumptions consistently to the point where I can actually financially model my next year based on the work that you guys are doing?
It is the hardest part of this particular role. It is impossible to know for sure how much your revenue is going to look like next year from an acquisition standpoint based on a particular spend level that you've never hit before. So if you're used to spending 100K a month, and for you to say that like, yeah, by June of 2026 I'm going to be at 300K a month, but you've never spent that much and you have no idea what the algorithm is going to look like at that
Yeah.
point. You don't know what your creative, how your creative is going to be performing, how privacy things might change. That's the hardest part because you're just assuming that, yeah, no, I'll triple my spend. I've never hit that number before. And yeah, my CAC will go from maybe 70 to 75. And like, again, maybe. I mean, some people can do it, but that's the thing where it's like it really is a little bit of just a guess and a little bit of faith, and then you just kind of argue. That's kind of why you do scenario analysis. You're like, okay, well, if I'm right, what can I do, and what if I'm wrong? What's the worst case scenario, and make sure that my business is able to sustain that situation as well. But that is genuinely the hardest part because to a certain extent you're predicting the future. That's kind of why the retention revenue is so helpful, because that part's a lot less of a guess. You have very clear historical cohorts. You can add some additional assumptions around the LTVs, but usually that's not the kind of thing that's going to triple your revenue or anything like that. It just adds a little bit more of a padding to what is generally a reliable base, because cohorts do tend to perform relatively consistently. Um, so that can make it a little bit easier. And then obviously the OpEx and stuff like that's a little bit more intentional. So that can be easier too. But really the hardest part of it is just kind of predicting uh, future acquisition performance, especially when there are substantial increases in activity.
Are you guys making a plan of like conservative, middle of the road, ambitious, or some version of that essentially that you're presenting to the team?
That's usually the best approach, like where you can go base, best, worst, and kind of plan it out that way. So that way people have a good understanding of like what the possible outcomes are. That's where possible. That's the approach we try to use.
Last question, and I'm on to here because I've taken up enough of your time. What are three core pieces of advice that you'd leave a founder or someone higher up in any of these e-commerce or retail organizations? What are three recommendations you'd make?
Firstly, make sure that you have a very thorough understanding of kind of like the financial data and the financial model and exactly how different pieces of it interplay together. I know it's not always the most exciting, though. If you have a really well built model, it can be kind of fun to do some scenario analysis. But I think just having a thorough understanding of it is very important to be able to do your job as a leader. The second piece of it is to really not bang your head against a wall when it comes to being able to crack acquisition and hope that things will get better. More likely than not, it will get more difficult over time. So you need to really be on the cutting edge of kind of like talking to the people who know what is working for the people who are solving that problem. In most brands' cases, they are heavily under investing in creative because, 3 years ago, you didn't really need good creative to be able to do well.
Mhm.
And so I think there's a huge underinvestment there. And the third thing, which I guess maybe kind of relates back to the first one, is that at the end of the day, even though e-commerce is a unique industry and a unique type of business and a very fun one, it is still a business. And so I think being able to kind of approach it as such and taking into mind the importance of like, just building a proper team, having a good culture, having good processes, having things that are organized, delegating stuff effectively, the stuff that's more like just kind of standard business practice that sometimes people kind of ignore because they just spend all day in ad accounts. I think those are very important, especially as you get to like the more big boy stages where like doing 8 figures.
Abir, thank you so much for doing this, man. I really appreciate it.
Of course, thank you as well. Thanks for having me.